Today, I'm going to share my deep drill down thought process of the life cycle of a cash secured put trade so that you'll be able to use that same process when you are using that process on your cash secured put trades. The trade that I want to look at today is an example of trading Adobe cash secured puts. Now this, I think, is a trade that I actually had on, if I'm not mistaken. I'm about this is a trade that I had on. So this is a real trade that I did. And here's how it went down. Adobe was trading at an 18P ratio when many of their peers were trading at much, much higher multiples.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 74, WWWD. What would Warren Buffett do? But before we jump in today, I wanted to thank the many listeners who purchased my new book, Build Consistent Wealth with Options. If you haven't yet, well, I know I'm biased, but I think you should. There's a lot of great stuff in there, really. Some that we covered on this podcast and a whole bunch more. If you have purchased the book, please leave a review on the online store at which you bought it, like Amazon. Derivatives. What an intimidating word for a financial instrument. In the past, they got some occasional bad press. Warren Buffett once called them financial weapons of mass destruction. They must be pretty dangerous, huh? Well, these days, people understand them better. And Warren Buffett, well, he famously used them himself, even before he maligned them with his hyperbolic quote. So, what are we talking about when we use the word derivatives? It's any financial product that is derived from, get it, derived, derivatives, any financial product that is derived from an underlying financial asset. So we're talking about credit default swaps, weather derivatives, forward contracts, futures, and options. Yes, options. The kind we've been talking about on this show for the last 73 episodes. Options are derivatives. Anything can be good or bad. Electricity lights my house, runs my computer that I'm recording this podcast on, regulates my mother's heart and her pacemaker. Stick a paperclip in an electrical outlet, and you get to see the other side of electricity. Eat more fish, they say. It can lower your triglycerides. It's good for your brain. It's anti-inflammatory. Fish is good for you. Leave it sit out on the counter for 5 days before cooking it, and, well, maybe not so much. With options, well, sure. There have been people who stuck the paperclip into them without turning off the circuit breaker and fried their accounts. But options can be, and indeed are, a useful tool when in the right hands, controlled by the right mind. How we use them as part of the wheel both produces higher overall returns and reduces overall risk. We put them to good use. As for good old Warren Buffett, well, his legendary, famous trade was selling 50,000 put options on Coca-Cola back in the spring of 1993. He wanted to either buy the stock or keep the premium. He used the exact technique that we have talked about on this show many, many times over. And it is the technique that today we are going to do a deep dive into. The last two shows that we did case studies on, as a matter of fact, we looked more at the skate objective trade. Well, today we're going to look at what I like to call the trade objective trade. With the trade objective trade, the main focus is on entry and exit points for the underlying stock. Cash secured put traders are planning their whole trade around what price they want to buy the stock. They're weighing their risks, many risks, including and especially missing the opportunity to buy that stock if the put doesn't get assigned. Investors can use a limit order to buy the stock at their target price. If the investors choose to sell puts instead, it's for strategic reasons. They hope to end up with smoother results over time, as a lot of missed stock entry opportunities are counterbalanced by the steady stream of option premium earned. Covered call traders who have the trade objective, well, they're planning carefully what price to sell the stock. In a lot of ways, I would say that selling the stock is a harder decision than where to buy the stock. Selling a stock too soon can risk foregoing profits, which can be a real concern, specifically on the next Apple or Micron, the next unicorn stock that could take off like a rocket ship and never look back. Missing the opportunity to take profits on a stock by targeting too high a share price, too high a strike price, well, that can be a real concern too, being too greedy, right? When investors sell covered calls, it smooths out the results of this whole decision-making process over many trades done over time. And the end result of this is a smoothing benefit that can be framed as kind of a product of adding volatility as an asset class to your portfolio. It's this idea of collecting option premium regardless of whether the stock is assigned to you, whether we're talking cash secured put or covered call, but really we're talking both over and over and over again is the point. And of course, selling volatility works because the investor can benefit from the risk premium, right? Which is generally over time overpriced. It is therefore an edge source. There are going to be winners and there are going to be losers, but it's the edge that really is the rationale for using the wheel strategy at all. And so the entire trading process, from entry to execution to exit, needs to be well conceived and really well executed. Today, I'm going to share my deep drill down thought process of the life cycle of a cash secured put trade so that you'll be able to use that same process when you are using that process on your cash secured put trades. The trade that I want to look at today is an example of trading Adobe cash secured puts. Now this, I think, is a trade that I actually had on, if I'm not mistaken. I'm about this is a trade that I had on. So this is a real trade that I did. And here's how it went down. Adobe was trading at an 18 PE ratio when many of their peers were trading at much, much higher multiples. The price to operating cash flow was 15.8. And again, same story. Many of their peers had much higher price to operating cash flow. So here's what happened. The stock had fallen to an already established support level of $335, bounced off it, and therefore support stayed intact. The 30-day implied volatility on the volatility chart was significantly above historical volatility, and there was no earnings for a whole month. In my analysis, the stock wasn't a tremendous deal here, but if the volatility on lower strike options is high enough, and it typically is higher on most stocks, right? The lower the strike price, the higher the implied volatility. then a cash secured put could have been a very strategic and interesting way to go about this. At the time, the stock was trading at $354.05. With the stock lower at, say, $340, the PE ratio would work out to be lower by about 0.7. At that point, I'd be a little bit happier with the stock as a value play, relatively speaking, relative to its peers. And the established support on this stock, especially in a tech market that was very bullish, helped support the buy thesis. That made it good enough to do some more analysis and look at some option values. At that time, I was thinking that $340 a share would be about as high a price as I'd like to pay for the stock at that point. That's the strike price that I started sizing up. And so I was looking at the August 22nd expiration, which was very short term. It was like 2 days until expiration. I just couldn't get enough premium selling those. But going out a week further, the August 29th expiration, which was 9 days to expiration, well, those 340 puts were $2.26 bid at $2.44. Assuming I would get filled selling them at $2.30, that comes out to a 27.4% skate yield, which I didn't think was too bad. I thought it was pretty good. If I went out still a week farther, the September 5th 340 puts, well, they had about the same implied volatility as the August 29th ones. And that volatility, which again was like 32 and change, was pretty substantially above the 27.21% historical volatility that was shown on the chart. Both of those choices, August 29th and September 5th 340 puts, they're both pretty darn good put sales. I could have sold the September 5th 340 puts for about $4. And that ends up being a 26.8% skate yield. So very, very comparable to the August 29th. If I went out still farther, another week to September 12th, then there was a significant jump in implied volatility. Whenever I see that, I always go and I look at the chart and I say, when was that last earnings announcement? And well, it looked to me that it was about 3 months before that. So it looked like we were coming close to earnings. I always say trust but verify. And I just Googled ADBE investor relations, looked for the events page or webcast page, and found that their earnings were just before September 12th. So I did not want to trade that expiration. Now, I could consider maybe even a lower strike with some of these longer dated expirations, maybe the September 5th or something. But what was my objective for this trade? The trade objective. I want to get a sign. Skating and accumulating cash through rolling until eventually being filled. I mean, that's always acceptable too in this case. But moving farther out of the money moves me away from my goal, both in terms of the likelihood of assignment and the amount of premium I'd be able to collect. So let's look at the opposite. I could consider a higher strike, right? But I'd want to collect enough premium that I'd have an effective purchase price at or below $340 a share. I could achieve that outcome with either the August 29th or the September 5th expirations, selling the 342.5 puts. September 5th, 342.5 puts, they were more effective, right? As they have more premium than the August 29th puts. So I'd have a better chance of getting assigned. But the 340 puts, they would get assigned at a lower strike price while not giving up too much premium compared with selling the 342.5 puts. So the 340 puts ended up being better to help me reach my objective in this particular case. So I ended up narrowing in on the September 5th 340 puts. Again, 16 days until expiration. The market was as when I say the market, I mean the bid-ask spread, of course, was just 25 cents wide. They had a decent amount of open interest. So it was reasonable to enter an offer 10 cents above the bid, 15 cents below the offer, so just below the middle. And it worked. I sold the puts at $4 a share. That's 26.8% skate yield. If I didn't necessarily get filled immediately, I would have just waited a couple of seconds and lowered the offer by a nickel and just tried to get it done. Boom, the trade is on. I have the trade objective. I want it to get assigned. I want those puts to get assigned so that I can buy the stock at the strike price of 340 minus the put premium, so effective purchase price of 336. So once I get filled, what's the first thing I do? Well, I enter a good till cancel limit order to buy to close that put at 10 cents. Wait a minute. Dan, didn't you just get done telling me that you have the trade objective you want to get assigned? Why would you put in a limit order to buy to close the put? Are you crazy? Well, maybe, but crazy like a fox. If I simply wanted to buy the stock at $340 a share, and that's that, well, I would have just entered a good till cancel buy to open limit order at that price. But it's the put premium that makes this strategy special, makes it different than just entering a good till cancel order in the stock. It partially insures me against not getting assigned. I get $4 if I don't get assigned. And for a single wheel cog, that might or might not be enough insurance today. But in this case, it was for me. In the future, on a different trade, it may or may not be. Imagine a scenario where time passes, Adobe stock has risen in price, and implied volatility falls. Let's say the stock rose a little bit. It's now at $359 a share, and there are 2 days until expiration now. And the at the money implied volatility fell by around 3 points. All right. I want to take a little short digression here. If you listen closely, I said the at the money implied volatility fell by 3 points in this example, right? But these puts started out of the money for this trade, right? And they became even more out of the money as the stock rises. And they became even more out of the money as the stock rose, right? So why do we care about the at the money volatility? It's because of skew. And I mentioned this in a previous podcast episode, probably a long time ago. In fact, I probably mentioned it a couple times now that I think about it. For most stocks, the lower the strike price, the higher volatility. In fact, I think I just mentioned this earlier in this episode. And then, of course, the opposite. The higher the strike price, the lower the volatility. So we can't really track the volatility changes by just looking at the same strike price. Because as the moneyness of the strike price changes, as it becomes more in or out of the money, well, its volatility changes as a result of skew. So it's a more fair comparison to measure how much volatility changed using whatever the at the money option is at the time, and then account for skew. Because if the stock goes higher, implied volatility goes down, that put is getting farther out of the money, and so it's getting a higher implied volatility because of the skew. But the whole skew slope, if you will, is going down. So there's a lot of nuance here, and we could go down this major rabbit hole here, and we're relating this idea of sticky strike versus sticky delta, and, all the volatility nerds listening to the show, like, it's very exciting. And I like talking about this kind of stuff. It's just interesting to me. But for our purposes, just know that the best thing to do is always to compare the at the money versus the previous at the money. Anyway, that's all I have to say about that. My digression is over. So we're back to fast forwarding, imagining that the stock's higher. There's now 2 days to expiration. And let's say right now, the market for those 340 puts is 9 cents bid, offered at 14 cents. And the stock is up. It's $19 away from the strike price, like I said before, right? The puts are less likely to get assigned, though it's not completely cuckoo bananas to think that a $359 stock could drop 14 bucks in a day, right? So you could hold on to the put until expiration, and hey, maybe you won't get assigned. Maybe you'll get to keep that 10-cent premium that I'm entering as good till cancel order. Or maybe you will get assigned and you get to keep the dime, but with more time premium because there's more time to expiration, right? You're not going to sell it at a longer dated expiration at a dime. It's going to be more. Now, you're probably not getting $4 like you did when you sold it the first time because it's farther out of the money, but maybe you get another dollar or another $1.50. Or because the cycle already racked up $4 for that cog of the wheel in net premium already, minus the dime you paid or whatever it is you paid. It's also not cuckoo bananas to sell maybe a new 2-week 345 strike put and maybe get another $4 for selling that put at higher strike. But Dan, don't you want to buy it below 340? Well, yeah. But then if I collected $4 the first time and $4 this time, that's $8 of cumulative premium. So if those 345 puts do end up getting assigned, the effective purchase price would be $337, right? 345, the strike price I'd get assigned at, minus $8 in option premium, the $4 I collected this time, plus the $4 I collected that time. So it's like I still get to keep buying at that low price even as the stock rallies because I keep collecting more premiums. And hey, if the puts don't get assigned, I can continue with this logic. The wheel continues spinning. Now, because we're looking at it with the trade objective, we're not really looking at it with the theta test that we talked about in the past. It's not just about maximizing option premium in this case. Here, it's more about maximizing the cumulative discount effect. It's maximizing my effective purchase price once I ultimately do get assigned. And I do that to either create an opportunity to get an even better effective buy price on a stock once I get assigned, if I ever get assigned on the put, or two, to have the opportunity to sell higher strikes to increase the chance of assignment and still accumulate shares at that same target price originally in the long run. So like I said before, as the stock rises, I'm still able to buy it at that original purchase price. I mean, that's wonderful, right? I only do that because I collect more premiums and I improve my cumulative discount effect. Now let's look at a new potential way this could have played out. What if the stock would have fallen a lot through the 340 strike price? Well, hey, you know what? That's the easiest management case of all. We just cancel the good till cancel bid and take assignment. That was the goal, right? And I know what you're thinking. Yeah, that sounds great in theory, but what if it's like way, way far below the strike price? That is going to happen time to time. The trade objective is for investors with the long game in mind. So unless something in your assertion of the value of that stock changed, you take assignment and you're kind of happy about it, regardless of whether you bought it at a price that's effectively a great deal higher than where the stock is. It happens even if you're not using options. You're still buying the stock as an investor at that target price that you would have bought it with a good till cancel order to buy the stock. And so you wait it out, or you sell calls and keep that wheel spinning. How about another new scenario? What if the stock is really close to the strike price at expiration? What if on expiration day, those 340 puts are in the money by like 50 cents only? Okay. We can do a number of things. We can take assignment, but we can also kind of slow play this a little bit. Just because we want to get assigned doesn't mean we have to get assigned yet. If on the expiration day, the puts that we sold 16 days ago at $4, they're slightly in the money just, they're going to be trading for at least parity, right? At least the in the money value. In my example, I said 50 cents. If it is actually expiration day, whether we're talking about on the open or on the close, kind of matters a lot, because expiration day has the absolute fastest rate of time decay for at the money options. If the put's in the money 50 cents near the open, they might be trading for $2 or $2.50 or more over parity. If it's like the last half hour of the day, last 15 minutes of the day before the close, well, then they might be trading at like 20 or 30 cents over parity only. You get all that time decay in that last 8 hours of the life of the option. Here's something that I just absolutely love to do when the situation calls for it, is to take these options that I want to take assignment on. They're in the money by like 50 cents or something, in the money by just a little bit, and we're getting closer to expiration. I like to roll them out a week and collect still more premium. Again, I'm saying when they're in the money. And what I do is I sell a put that has that same in the money strike, or maybe even a slightly higher, more in the money strike. As long as I'm taking in time value, so premium over parity, and I'm in the money, maximizing my chances of getting assigned, I'm doing something smart. The caveat is that by rolling, I'm accepting the risk of not getting assigned on something that, was already a lock for getting assigned. And that's why a lot of times I will sell that slightly higher strike. So the at the money put is going to have the highest time value, and so would add the most to the cumulative discount effect, right? So imagine I'm rolling those 340 puts, which are now at the money or just smidge in the money, 1 week out to the exact same strike, and I collect a credit of 550, buying to close the expiring one at, say, maybe it's the middle of the day at $1.50, and selling the new one at $7. I'm taking in a net credit of 550 on the roll. Well, that gives me a total cumulative premium of $9.50. That's the original $4 that I sold it for, plus the net premium credit from the roll, $5.50. Basically, all I do, like the best way to think about it, is just taking all my credits, subtract out all my debits, and that's how my cumulative discount effect improves. So now with a $9.50 cumulative premium, the new effective break-even price would be $330.50, right? That's the new 340 strike price that I sold minus the $9.50 in cumulative premium. But if instead I sell a slightly more in the money put that gives up a little bit of time value, but it gains more of basically a hedge. For example, okay, same example. The stock is at 340. I sell a 1 week 345 strike put at, say, $9.75. It's more in the money, so it's a higher strike, not $7, but $9.75. Well, there I'd accumulate another $4.75 of time premium, because $5 of intrinsic value, right? But that $5 of intrinsic value basically gives me one-to-one coverage for the stock to rise and still get assigned. This is a different way of thinking about time value and intrinsic value, but it's a good way to think about it. the stock can rise from $340 up to $344.99, just leaving those 345 strike puts a penny in the money, and I'm still going to get assigned. So that $4.75 of time value we take in this time, plus the $4 we took in the first time, that's our aggregate time value. So we're still looking at a pretty good effective purchase price. And I do want to be clear about something. It's continuing the risk of not being assigned if I do it this way, if I do roll it and don't let it get assigned today and instead roll to in at the money or a more in the money one, right? But at least rolling to the more in the money put, the higher strike put, the odds are more in my favor of assignment, but I'm still benefiting from adding more cumulative time premium. The actual results of how this actually worked out is that 2 weeks later, Adobe fell to $341.50, and I rolled. I bought the puts back at $2.67 while selling to open the 335 puts that would expire in 8 days for $12.67. And I did go to a lower strike because I found other opportunities that I was starting to like more than the Adobe opportunity. So I was still selling just $6.50 out of the money, and my $12.67 premium reflects that. I was still taking in a really meaty premium. I only collected $4 the first time. Now I was collecting $12.67 on this one. So I really love that trade. It ended up, I didn't get assigned on that cog. The stock headed back up to around $350, and I rolled, buying to close the 335 puts at 25 cents while selling to open some new 335 puts at $3.50. And so note that I stuck with that $3.35 strike. I deprioritized assignment on those puts and kind of shifted a little bit more towards the skate objective. Because we can have that sliding scale between objectives, skate objective, trade objective. I can just really want one or the other, but I can be somewhere in the middle too. As this continued to play out, I rolled 2 more times, not getting assigned. I rolled down to the 330 strike and then down to the 310 strike, just taking in more premium each time and not getting assigned. And this is kind of an interesting one to talk about when we're talking about the skate objective, because it's one where I changed my mind part way through the trade. And it's not that I necessarily changed my mind on that stock. It's just that any investor only has so much capital. And I found other investments that I prioritized more than this stock. And it didn't stop me from selling premium on it. And gosh, if I would have gotten assigned at the 310 strike, I would have been really, really happy at the time. So like I said, I thought I'd share this one. It was straight from the book pretty much. It is a trade that I actually did, and I thought that you would find it interesting. And that about wraps it up for this show. But before you go, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. And if you're already subscribed to the show, you can go even deeper and get more with a paid subscription. With your paid subscription, you'll get video extra podcast episodes, so you can get hands-on video training on things we talk about on the show. Subscriber-only posts, where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades and much more. And the best part is your paid subscription helps keep this show on the air. To join the list of Wealth Building paid subscribers, just go to the Wealth Building with Options Substack page and sign up. The shortcut to that page is wealthbuildingpodcast.com. That's wealthbuildingpodcast.com, and choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching class and our Smart Income video class, which alone is valued at more than your Wealth Building with Options paid subscription. And if you become an all-in wealth builder before I run out of books, I'm going to send you a signed copy of Build Consistent Wealth with Options. Once again, you can sign up at wealthbuildingpodcast.com. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.